This is Helen Tarrant at the Cash Flow Queen. Today we're talking about different ways where you can save money, loopholes in tax, and different investment vehicles that can give you maximum cash flow and income. Why is that so important? Raising cost of living, expenses, we're going to need more cash flow. As interest rates goes up, we're needing ways to find ways to minimize expenses because cost is the enemy, and getting more cash flow into your pockets allows you to retire faster, allows you to achieve your dreams, and allows you to buy more property, right? And so if any of these strategies I'm telling you make sense to you, you do need to click the link below, subscribe, but also book in for a strategy session, because on those strategy sessions, we're going to be able to customize how the commercial property works for you, or different vehicles, and how to really build out your portfolio using both residential and commercial property to really accelerate your retirement journey. So let's get started. Some of the main ways, the really important three major elements that people look at when they're investing, doesn't matter whether it's residential, commercial, businesses, shares, whatever it is these three things. Number one is the right structure to be able to give you tax minimization. So let's come back to that. So what exactly is the right tax structure? Is it in your personal name, in a company, in a trust, or if you're doing a joint venture, should it be a unit trust, right? There's multiple ways. Should it be a self-managed super fund? So there's the entity, right? Number two is about asset protection, because what's the point of accumulating everything when someone could attack you if you are in a high risk profession? So if you are a direct consultant, if you're a doctor, you're a lawyer, even accountants, you could be sued by one of your clients and therefore wipe away your assets, right? All the stuff you work really, really hard. And then number three, more cash flow. So what are some ways to combat expenses, right? Combat expenses to more cash flow into your pockets, right? So those three things are really fundamental to your success in your investment journey, and also growing out and retiring faster. And really, the wealthy knows how to do this so that they can get to wealth so much faster and minimize tax at the same time. So of course, we're not talking about having offshore companies, not being tax residents. I mean, those are a lot more complicated and is the next level. And unless you're trading tens and 20s of millions of dollars, you're buying that type of property at once and you're building $100 million portfolio, those things are really too complicated and too expensive for you to implement, right? So let's start out in the beginning. And don't forget, if this video applies to you and you're thinking I'm getting really great value, don't forget to subscribe and hit the bell, but also to book in for that strategy session, pass it on to your family and friends, because this is key knowledge you need to know in order to move forward. All right, so let's talk about entities, right? Let's talk about buying the correct way. Now, when I first started in my commercial property journey, I didn't know, right? I bought stuff in my own name, and consequently, when I come to refinance that property now, 5 years down the track, I want to hold on to it, I'm struggling with issues of holding on to it. I'm struggling with the fact that the bank is going to give me a higher rate, and very few banks will refinance it because it's in my personal name. Now, if you have a residential property, it's totally fine, because almost all residential property people own it in their own name. Some people own it in trusts, right? Now, one of the big things about owning it in an entity is that when you own things in an entity, it's quarantined away from you, right? Which is very, very important. So when you grow a portfolio, you need to think, what am I going to do to protect that portfolio? So when you put it into an entity, especially in commercial property, you get really, really good lending conditions. So what does that mean? It means you get a good rate, a discounted rate versus holding it in your own name. You get to quarantine, which means it keeps the assets protected, which we'll talk about later, but also allows you later on to refinance and pull out that money, but allows you to set up a really effective way of being able to loan from yourself to your entity. So let's say that myself, Helen, is going to buy a commercial property or a residential property. It doesn't really matter which one you're buying, right? And let's say that the property is $1 million. And in order to buy this property, I need about $200,000, maybe $250,000 in deposits, or maybe more if I'm getting a lease stock loan, right? And your situation will vary. But let's say I need that, right? So what I'm going to do is I'm personally going to lend that money to my trust. And the trust might be Helen One Commercial Investments or Helen One Property Trust, right? So it has a corporate trustee underneath, which means it has a company that I am a director of, and I can direct where the flow of money comes from, right? So let's say I'm buying a commercial property and it then produces me a $10,000 cash flow a year. Right? And if it does that, I can flow through it and decide to distribute it to myself, my partner, my kids over 18, if I have any, my family members, my parents, or an associated company, right? Where I'm going to pick up maximum, 28% or 27. I think the tax rate's a little bit less now at the moment. It's about 27.5 or somewhere around there of tax, right? So if I'm on the highest income bracket and I'm paying 45 cents in a dollar, it would make sense for me to buy the property, apart from the fact that the bank is going to give me a better rate, sometimes the difference of 1% holding in your own name versus your entity. And this is very specialized for commercial. In resi, it doesn't matter whether you're doing it in trust or your own name, but in commercial, if you do it in an entity versus your own name, you actually get a better rate, right? And a better term. Right? So sometimes it can be 1 or 2 years longer. So therefore, say I've lend my trust that money, then I've got $10,000 that passive income comes out. I distribute it to myself or my partners, and I might save that money. So instead of paying $4,000 or $4,500, I might pay $2,000. I might pay $2,500, or I might pay zero because my parents are not earning an income and I'm distributing it to them. I'm helping them support their lifestyle. So it all depends on how you distribute that. And that's one of the things, to save that tax so that you can minimize your tax, you can maximize your cash flow. So it's all about minimizing and maximizing, right? So what else is beneficial to holding it in entity? So for example, you're doing a development. If you hold it in a separate company, if something happens, and we see developers go broke all the time, we see projects drag out, we see projects going into a loss, a liquidation all the time, this is where it comes in, right? So you go to a project and you've made a loss, or a project that's not working, or maybe the project has worked, you want to then sell it off and then close down the company. And that quarantines it away from you. So that it leads on to my second point, is that it reduces your risk personally, right? Let's say you've been working really, really hard to build your portfolio. The last thing you want to do is to have someone come in and attack you for it, right? So like if you did your development deal and it's gone wrong, or that something's happened to your tenant, or something's happened to the building more than anything else, because the tenant will have their own business insurance. Something happened in the building and then it affects you. You don't want anybody coming after you. You want them to be quarantined in the actual entity itself. Now, if you have a partner you're doing with, and might not be your wife or your family member, it might be a friend or a colleague, you want to make sure that is safely held in a unit trust. So the two of you are together, binded, but also can be separated, right? So this way it's not so messy, right? Because the more messy it is the more money you're gonna need to shell out at the end, right? So you want to quarantine it. And of course, the bank likes these kind of entities, so it gives you better benefits, faster, and it's cleaner as well. So it saves you money. So holding it in an entity, in the right entity, saves you money in terms of the cash flow coming in, because you can distribute it anywhere. It often saves you land tax, which is really important, because when we think about it, the number 3 thing is cost is the enemy, right? And land tax, especially in areas of Victoria and New South Wales, it's worthwhile to distribute that land tax to individual unit holders or individual people who don't actually have property in that state, right? That's really important. So those are the things that can definitely add more returns back into your investment. If you look at the amount of tax you would save and then the amount of land tax you would save, those things could add easily 0.5% difference to your investments, right? Now, that flows on to the second thing. When that comes in, you want to protect your assets, right? Secondly, it's about asset protection, right? You can hold it in an entity, and the reason we hold it in an entity is the asset protection. But the reason I talked about you loaning the money to your entity is because that entity itself then doesn't have any equity as such. It has 100% finance, one from you and one from the bank. Now, you can do all sorts of things when you lend the money. It can be a private agreement, be a caveat, it can be a second mortgage. All of these things can be put on title after it settles, right? But the important thing is then you don't have equity. So if someone attacks you and they tax that property, there is loans attached to it, and what happens is the equity only happens in time. So let's say you loan the entity, $250,000, then you got a loan for $800K, the $50,000 paid for the cost of the purchase. Now it's 100% finance, but maybe in 1 or 2 years time, it might be worth 1.2. Now you've got 200K in terms of equity. Now, if someone attacks you for it, they might be able to pick up that 200K or part of that 200K, but they're not going to be able to touch that, very seldom like able to touch that deposit from that you've put in, right? But then also that makes a really good tax benefit for you later on when you refinance, because you're paying back a loan versus that it's a return of capital where it's treated differently and you may have to pay tax on it, right? So those are really important things. And then following from that is that asset protection. If you're working hard to achieve an outcome, you're working hard to build financial freedom, you want to make sure that you are protecting your assets, and holding in an entity really does protect your asset and quarantines from one property to another. So you can be in development in a separate, definitely a separate company or entity, By your investments, it's giving you cash flow in a different entity. If you're working in a business as a consultant, it's in a trading entity, a different entity again. And if you own any licenses or any royalties or anything that is IP driven, so intellectual property driven, that's held in a different entity, right? So it's all separated, and that there is links throughout through paperwork. Good lawyers and accountants will set up the right paperwork where one company may be loans to the other company, one company may pay licensing fees or royalties to the other company, but it's important to set up that structure so that you know that you're protected. If something happens to you personally, you want these entities to stand on its own. You want the properties to be generating profit on its own. You want to know what gets sold and what is left for your family, because that is all about estate planning, but also planning the overall portfolio. And we have a conversation with you about that as part of our strategy session, because it's important to do the planning. And while it might seem tedious in the beginning, but if you fail to plan, you plan to fail, right? And you don't know what curveballs the world throws you. So it's important to have these structures in place just in case, and to think forward 5, 7, and 10 years. And that's why that strategy session is so important, and joining a community and attending events to find out more and learn to have a little bit of knowledge helps you to go a long way. So I've got links below, so make sure you click the right link and book in for that strategy session. But moving forward, now that you've got that protection in place, you know that you're safe and secure, you can move forward to now eliminating the cost. Now in cost, when we look at property or business, not so much in shares, but business, resi, commercial, cost is the enemy. Why do I say cost is the enemy? Well, let's look at it. And I'm not talking about management fees. Management fees should not be treated as a cost. Management fees should be an investment. Finding a good property manager, even sometimes paying them 1 or 2% more, could mean that they could add back-end value to your property. A good 10% value to your property over time well pays for their property management. So I always look for really great key asset managers and property managers who can not only be problem solvers, but deal with our clients and increase the value of the property. And I don't care how much I pay them, right? I'm not going to scrimp on it. I'm not going to say your fees at 4% or 5%. I only want to pay 2 to 3%. That is the wrong way to look at it, because you want them to spend more time on your property and less time on your property, right? And don't give them a hard time, because if you do, it always comes back, right? But talking about minimizing costs, there's certain things that you can do. For example, solar. If you have a commercial tenant, you could put solar on the roof, help that tenant to reduce their bill. In turn, they may be able to want to pay more rent, and makes it more valuable. But things like if you have a multi-tenanted property, a lot of people think multi-tenants are really good, but then you've got to look at eliminating costs. That's your cleaning, your gardening, general electricity, and your general maintenance. Those 4 things are what really kills you in terms of the cash flow, right? Because everything is rising, right? Everything is rising. Cost of living, cost of tradespeople, cost of materials. So you want to make sure that you actually are able to cover it, but you minimize it, you check it all the time, including your accounting and legal fees, but mostly accounting fees. And I know that sounds terrible, but if you have to lodge a BAS, an account that you need to pay on a monthly basis, $300 or $400, it's probably the same as an account you can pay $200, right? And that adds an extra couple of $1,000s into your pockets, right? It all counts, right? Also, obviously assessing your mortgages every few years, every couple of years, refinancing, tweaking, see if you can bring the rates down is also really important. But the most important thing here is that you've got to look at your costs on a yearly, or if not on a 6-monthly basis. Reduce your overall costs. Maybe, it's better LEDs in there so you save electricity, solar, maybe cleaning can be reduced. Maybe you can find a different cleaner. Maybe you can talk to the tenant about maintaining it, giving them a little reduction on rent. Those things really matter, right? Those are going to bring your costs down. But the other big things is depreciation. Depreciation for someone who's a high income earner, or you're generating a lot of cash flow, it's so fundamental. That's why new builds, newly refurbished properties, or properties that you are going to say knock down or rebuild, or you're going to do an extension on, or you're putting in fit out for the tenant, becomes so important in commercial property. And the reason I talk about those 3 things is you do get more depreciation out of a commercial property than you do residential. All those things they said you can't charge now for residential, you can still do for commercial. They even have scrapping fees when you remove a fit out and put a new fit out in, right? So what does that mean to you? That means that with that depreciation, it actually is a paper write-off of cash flow, right? If you're on a high income bracket and you get something with high depreciation that can say $20,000 or $40,000 a year, it literally saves you that much in tax. It saves you 5 or 6 grand, sometimes 10 grand in cash. Now, a lot of people say, yes, there is the add back provisions in the future when you sell it, but $1 today is worth more than $1 in the future. And that allows you to save tax now, accumulate more deposit, and buy again. So these are multiple ways of being able to save money. But remember the 3 fundamentals, right? You need to have tax minimization strategies in place. So the right entities for the tax minimization, asset protection, so you don't lose everything you earn if a project goes south, and you minimize also then that flows on to minimizing tax. So for example, in Queensland, you've got threshold for $350,000 for land tax for each entity, and it's not pulled together like Melbourne or Sydney or the other states, right? So you want to set up a separate entity for each property so you save on the land tax, right? So cost is the enemy, right? Make sure you scrutinize your costs, but not property management, asset management, but definitely scrutinize all your costs to make sure you keep reducing that cost. And of course, then we talk about that cost leading on to depreciation, how that's going to help you write off some of your positive cash flow. So 3 fundamentals you've got to remember, right? Cash flow and tax minimization to give you more cash flow in your pocket. Number 2, protecting your assets. So asset protection to make sure you've got willable assets for your kids in the future. And number 3, cost is the enemy, and really minimizing that cost. So if this video has been a benefit, thumbs up, you know the drill, right? Subscribe, hit the bell, share it with other people. But most importantly, booking for that strategy call, find out how Unikorn Commercial Property can help you accelerate your retirement plan. My name is Helen Tarrant, Cashflow Queen, and I'll see you in the next video.